Well, thank you, Sam, for that introduction, and welcome to all of you who are attending out there over the internet and by telephone. This seminar is one that was last given, or that I last presented anyhow, in 2008, and there's been a lot of different changes that have gone on with FDIC and NCUIF insurance since that date. As a matter of fact, I was looking over my notes for that last program, and a lot of what I talked about back then were some of the first things that the agencies and Congress began to do in order to react to the financial crisis that started, or really came to a head back in 2008. And it's interesting to note that, for instance, that year was the beginning of a series or a long number, or a fairly large number of bank failures. And these numbers that are showing on your screen now are bank failures that are of FDIC insured institutions, because they were the easiest numbers to portray. At the end of 2007, and during that entire year, only 3 FDIC insured institutions failed. And the pace began to pick up in the next year, where 25 banks closed their doors. And as you can see, over the ensuing years, 09 and 10 and 11, the numbers were fairly high. And then back in last year in 2012, they tapered off somewhat. And so far this year, as of Monday, 16 financial institutions had closed their doors, lost their FDIC insurance, and basically been either placed into conservatorship or shut, one or the other. So that there's a good number of banks. It's 481 banks in total that closed during those years, 2008 through today. And the other slide, if you will, the other graph that sort of portrays the same idea is the number of insured banks that the FDIC reports. It's interesting that whenever the FDIC sends out a news alert or a news release, at the bottom it indicates the number of institutions for which it is the federal insurer. And at the end of 2007, it was 8,600, over 8,600 financial institutions, and that includes savings and loans, savings banks, and so-called commercial banks. As of this Monday, that number had dropped down to 7,019. So it's almost 1,600, almost 1,600 fewer banks today than there were back at the end of 2007. And all of that really speaks to the difficulties that banks had. And I think it also speaks to the fact that during that period, there were a number of customers who were rather anxious about their deposit insurance coverage. And I suspect that if this webinar had been presented in, let's say, 2010, it might have had some additional interest just because of the fact that customers were still concerned about their banks. But banks in general seem to be stronger, and we're now working our way out of the situation to the point where, as of the beginning of this year, virtually all of the special measures that had been in place, either put in place by Congress or put into place by the FDIC and the NCUA, have gone by and elapsed, and we're left back with more or less plain vanilla insurance coverage, which is the sort of the insurance coverage that we had prior to this whole mess beginning, with one important factor that has changed, and we'll get to that in a few minutes. Anyhow, just as by way of review, over on page 2 in your handouts, there's a few lexicon items, and I just want to point out the fact that we're talking about either the standard maximum deposit share insurance amount or the standard maximum deposit insurance amount. SMDIA for FDIC insured institutions, and SMSFIA for credit unions that are insured under the NCUIF, the National Credit Union Insurance Fund. By and large, the regulations of the FDIC and the NCUA are pretty much on track with one another with respect to their insurance coverage and the types of coverage and limits of coverage that they provide. Because of the unique nature of credit unions, there are some references that don't track exactly to the FDIC regs, but the end result is essentially the same. And we'll talk about some of those minor differences as we go through this presentation, but we're not going to focus on the differences. We're going to focus on what the insurance coverage in general is. And the reason that they're the same is, frankly, they both have their origins under the Federal Deposit Insurance Act. And the FDI Act basically covers both FDIC and NCUA insurance. And whenever the FDI Act is amended by Congress, then both the FDIC and the NCUA act to update their regulations. During our presentation, I'm going to be referring to customers and deposits, and I do so out of habit. I come from the banking industry. I never had the pleasure of working in a credit union, although obviously I know that credit unions refer to members and they refer to share accounts by and large. For those of you who may be credit union representatives, please understand that I certainly recognize the fact that you're out there and that this information is meant for you as well. Beginning on page 3, there's some myths that are often brought up with respect to the banking industry and insurance. And these myths get in the way of customer service, I think, because they just aren't true, and customers can be misled by them. If we were talking about a unfair or deceptive statement, any one of these 10 insurance myths might, in fact, be construed to be unfair or deceptive if it's provided by a bank or credit union representative to its customers. The first one is the most obvious one, and that is that depositors are limited to $250,000 in insurance coverage per institution. And that's not true. It's not true for a couple of reasons. The main one being that there are different ways in which accounts can be held. Obviously, there are individual accounts, there are joint accounts, there are accounts that can be held in revocable trust form, or in more layman's terms, trust for the benefit of, or POD accounts. And there are separate layers of insurance, each limited to $250,000, depending on the customer's rights and capacities. So we'll talk at length about different types of insurance during this presentation. There used to be a myth that swept around the country that, boy, if I use different Social Security numbers with my deposit accounts at the same institution, then I'll get more insurance. For instance, if my wife and I are joint holders of an account, if we have two joint accounts and one of them lists my Social Security number first, and the other one lists her Social Security number first, then we'll get twice the insurance limit, and that's just simply not true. As a matter of fact, the Social Security number that is on an account is absolutely immaterial. It has nothing to do with the amount of insurance that's afforded by the FDIC or by the NCUIF. It is the ownership of the account that matters and how the account is held. There used to be a suggestion that just splitting accounts up into multiple accounts would afford more insurance. So if you you had one account with $250,000 in it, you just opened another account, put another $250,000 in it, and you'd have $500,000 worth of insurance. Well, it isn't that